Hello everyone and welcome back to part 2 of the video series for course 201, Building Statistical Arbitrage Trading Strategies. And part 2 of this video series will cover Bitcoin futures markets and how we can build statistical arbitrage trading strategies to become market makers in Bitcoin futures contracts. So first, let's cover the risk disclaimer. Everything discussed in this video and all content on marketmentor.io is for educational purposes only. I am not in any way providing financial advice or soliciting financial products. Trading futures markets carries significant risk and can result in loss of capital. So Bitcoin futures markets is an exciting topic, especially these days. It's a very important concept to grasp if you are into financial markets and trading in general, as Bitcoin is one of the hottest financial markets in the world right now. Let's take a look at a article from CoinDesk, and this was on July 28th, 2020, and today is August 4th, 2020. So this is very recent news. Bitcoin futures volumes surge 186% as the Bitcoin price crossed 11,000. And basically what we're seeing here is that Bitcoin derivatives markets or Bitcoin futures markets are really starting to um, be in play as the Bitcoin spot market begins to gyrate up and down and volatility increases. So futures markets are being used to hedge spot market positions. They're being used to hedge options positions, which those markets are also really starting to pick up in volume. And Bitcoin futures markets are also used to take speculative positions on the direction of Bitcoin, of the underlying asset. And what we're going to look at is how to bring liquidity into these derivative markets, into these futures contracts, so that other traders can participate and execute against our resting market making orders. And also, simultaneously, we're providing a service to these exchanges that are hosting these contracts. As Bitcoin is an immature asset, a relatively new, especially compared to other traditional futures markets, it's a very new asset. Liquidity is not deep, and that is an opportunity for market makers or traders with a statistical arbitrage approach to the marketplace to really benefit from the opportunities presented in a new market. Another article we'll take a look at is from Decrypt, another well-respected news source in the crypto markets, and this was actually posted today, August 4th, 2020, or I should say the day of the video being recorded. And the title here is Activity on Bitcoin's Regulated Futures Exchanges Has Never Been Greater. The subtitle here is Open Interest on CME's Bitcoin Futures Markets Has Hit Another All-Time High, indicating increasing interest from institutional investors. And this is really something that we want to key on here. As Bitcoin, the underlying physical spot market asset, really gains traction from the institutional side of things, and really from more traditional institutional investors. Typical thought would be Wall Street. As they step into this market, the derivative space, the hedging aspect of managing risk around these investments really begins to pick up. And with that being said, the demand for liquidity in these, especially in regulated futures markets, is really, there's really a strong need for good market makers and liquidity providers on these regulated exchanges, as institutional investors, especially the traditional institutional investors, are looking to execute on regulated derivatives exchanges. So if we scroll down a bit, we'll just look at in brief the CME Bitcoin futures open interest is currently sitting at 830 million. That's an all-time high for the complex at the CME. And this is another interesting one as well. For the first time ever, a regulated futures exchange is now in the top 5 futures exchanges by open interest. So again, we're focusing on regulated futures exchange. And then now they do talk a bit about Bakkt. Bakkt is a competitor to the CME, another exchange. Wouldn't be a bad idea when I talk about looking at other exchanges to deploy these types of strategies on, or to think about different types of markets aside from the CME. The backed is the Intercontinental Exchange derivative marketplace for Bitcoin. So another regulated exchange, and they're seeing some increase in open interest there. Now, just to take another look, if we scroll down, this is some data from Skew, well respected data provider in Bitcoin or in digital assets markets more generally speaking. And this is a chart of CME Bitcoin futures total open interest. So this is an interesting chart to take a peek at. As you see, open interest is rising. The black bars here are daily volumes. So what we're seeing here is contracts being held open. Although volume spiked here, now we're seeing the volumes decline a bit. The open interest in the contract has been increasing. So that's very interesting. And then you see just a quick blurb down here. Typically, unregulated exchanges often attract more futures trading volume, and this has traditionally been true in digital assets. And digital assets really came to life on unregulated exchanges, and now we're really starting to see the regulated venues, notably CME backed, starting to be, and really CME to make a point of it, starting to become in play across the spectrum. So I think that's an interesting look at the market. And there was another chart I wanted to cover here before we move on to talking about the markets. It's the BTC futures aggregated daily volumes. So if we look at this chart here, this is a time chart here that we're looking at: March, April, May, June, July. We see July, just the aggregated volumes just exploded, and this coincided with the increase in Bitcoin's price crossing 11,000. We see the only other time it was the aggregated volume was greater was in the middle of March, which as if you look at the chart is when Bitcoin was actually making lows on the year in a capitulation event. And if we look below the months that are listed here, these are some exchanges that are being the data is being aggregated on. And we see there's many exchanges that have futures markets for Bitcoin, and they all need liquidity providers, and they're all these types of this is where you can really begin to think about the scope of how these strategies can be deployed across financial markets, and really you can start to see the opportunity, and it's likely that the number of exchanges will continue to expand until it hits a point where liquidity will start to center in a select few. Maybe there will be a top 5 or a top 7 derivatives marketplaces where nearly all the volume transacts. I think that would be further down the line from this point in Bitcoin's development into derivatives markets. But there's an interesting overview. And just to cap off our focus on the institutional investor coming into Bitcoin derivatives markets, if you look at digital gold, we talk about that institutional investors are coming for Bitcoin, and really the year 2020 is just a significant year. It will go down on the Bitcoin timeline as kind of an inflection point for the institutional capital adoption, especially the traditional institutional capital adoption. And also in the book, we talk about the importance of liquidity and why institutional participation really requires a deep order book in the markets they participate in, because quite frankly, they're putting on size, they're putting on large positions, and for them to manage risk, they need to be able to execute against a deep order book. So these are some topics that we do dive into in the Digital Gold book, which is available through the mentorship package or individually on the website. But moving to this course 201 part 2, Bitcoin market making strategies, we're going to start in the book, and we're on page 58 in the book. And the reason we're here is that there is a bit of a confusing topic that needs to be tackled before we can really grasp what these Bitcoin futures markets and listed calendar spreads on the CME are all about. As we have been learning thus far, predominantly in the gold market, There's some differences between gold futures contracts, which are more traditionally priced compared to the Bitcoin futures markets and listed calendar spreads, which are what I would say unconventionally priced. And the first point to make on the unconventional pricing is the reduced tick calendar spreads that are used in Bitcoin futures markets. So for gold, the gold outright markets and the gold listed calendar spreads have a minimum price fluctuation or a tick value that is equivalent to each other. So one tick in a gold outright is plus or minus $10 per one lot relative to your position if you're long or short. And the same is true in the calendar spread. If you're long the calendar spread, the P&L is plus or minus $10 per one contract, depending on the move up or down. And it's same if you're short one contract, the P&L is plus or minus $10 per tick, depending on the direction of the market relative to your position. In Bitcoin, the calendar spreads operate on a reduced tick pricing methodology. So the fundamental concept to grasp between a reduced tick calendar spread market and a conventional tick calendar spread market, or maybe a better way to say it is a standard tick calendar spread market such as gold, is that the calendar spread has price increments that move in an increment of 1, whereas the outright market has price increments that move in increments of 5. Now, there are 5 Bitcoin per futures contract, thus each $5 tick in a Bitcoin outright market is plus or minus $25 per contract relative to the direction of the market compared to your position, long or short. In the calendar spread market, the minimum tick is $5 as the tick size in the spread moves in increments of 1. Now to say it one more time, the outright market moves in tick increments of 5, and there's 5 Bitcoin per contract, so it's $25 per tick. The calendar spread moves in increments of 1, and it's 5 Bitcoin per contract, so the calendar spread tick value is $5. Now, when you can grasp this concept, you begin to ask, how could the calendar spread trade in ones when the outright trades in increments of 5? And if we think back to part 1 of this video series, and we're market making in the outright markets relative to the calendar spread, we will also find here in Bitcoin that as we make markets in the outrights, leaning against the calendar spread, we can only make markets at what we call the nickel prices, and we will demonstrate that in simulation mode. But the synthetic spread that we can create in Bitcoin outright markets can only be in increments of $5. So I could make a spread for 135 minus 135. I could make a spread for minus 130. I could make a spread for minus 140 synthetically in the outrights. But in the calendar spreads, if I so choose, I can bid and offer in between the nickel prices. And this presents some very interesting opportunities. So just to take another look at it here, the calendar spread must trade 5 ticks in either direction to match the notional value of 1 tick move in the outright market. So that would be the calendar spread moving from minus 130 to minus 135. The P&L on a one lot calendar spread position would be $25 from 130 to 135, and then $25 more from 135 to 140. Just as in the Bitcoin outright market, each tick is $25. And the more savvy a trader is, the more opportunity can become available to that trader if you can grasp this reduced tick calendar spread. I think it'll become more clear once we begin bidding and offering synthetically. So that is a quick look at the at the reduced tick spread. Now, what we want to take a look at next is another concept that really just needs to be accepted, and it's the idea that the Bitcoin calendar spreads are priced with an inverse order of operations relative to a conventionally priced calendar spread. And before we get into the nitty gritty of what this means, I think it'll become very clear once we jump into simulation and bring up both gold and Bitcoin markets to take a look at the reduced tick spread and also the unconventional calendar spread pricing. But in short here, when we learned about gold, we learned that the calendar spread was priced as leg 1 minus leg 2 equals the calendar spread. And if I was to buy the calendar spread, I'm buying leg 1 and I'm selling leg 2. Or if I was to sell the calendar spread, I'm selling leg 1 and buying leg 2. Now in Bitcoin, and I do believe there's a few other calendar spreads at the CME that have this unconventional calendar spread pricing, although it is very rare. Most of the calendar spreads are priced leg 1 minus leg 2, but in Bitcoin it's leg 2 minus leg 1 equals the calendar spread. And this just simply needs to be accepted. This is just how the pricing mechanism and the pricing protocol was designed on the back end for the CME matching engines and order book management systems. So this just needs to be memorized, that the Bitcoin calendar spread is actually leg 2 minus leg 1. And that being said, what you do to the calendar spread, you are doing to leg 2. So if I buy the calendar spread, I'm buying leg 2 and selling leg 1. If I sell the calendar spread, I'm selling leg 2 and buying leg 1. And I think I do discuss that in the book on page 60 and then on page 61. And I also get into it a bit, obviously here on page 64, on how to grasp this. So right now we're going to transition over to the TT simulator and go through the reduced tick spread, what that means, and also the inverse order of operations for pricing a calendar spread, leg 2 minus leg 1, as opposed to conventional pricing, leg 1 minus leg 2. And I think the last page I just want to bring to everyone's attention is page 66 for understanding nickel pricing and the reduced tick calendar spread pricing. But we're going to dive into it here on the simulator. So I'm going to pull up right now. And we'll pull up the Bitcoin outright markets and calendar spreads that we're going to take a look at, and I will also pull up the gold. So let's start with gold. We've been focusing on that. People are familiar. Let's pull up the gold VZ outrights and listed spread. And let's pull up the spread. GC. Octis. Here's the Octis. Alright, I'm going to make these windows a touch smaller. so that we have room for Bitcoin. All right, so just to settle in with what we're staring at, here's the gold October 2020 outright market, the gold December 2020 outright market, and the gold October 2020 December 2020 listed calendar spread that we covered in part 1. And we see the market is still relatively near where we were talking about it. It's minus 12.2 bid at minus 12.1 offer. And let's pull up Bitcoin markets below. We can pull up, this will be BTC. We can pull up the August contract, as it's a financially settled market. You can trade this thing till the termination date of the contract, which is the last business day of the calendar month. That's all discussed in course 101. And now we'll pull up the Bitcoin September outright, which is just the next contract month. And we'll pull up the listed calendar spread for BTC AUG-SEP 2020. Here is the listed spread. Okay, let's try to make this a bit smaller so we can take a look. Perfect. Okay, so now that we have our spreads, our markets up, again, let's go over gold October 2020, gold December 2020, gold OCD spread, Bitcoin August 2020, Bitcoin SEP 2020, Bitcoin AUG SEP calendar spread. Let's look number one at the first difference that should stick out to everybody. The Bitcoin calendar spread is a positive number and the gold calendar spread is a negative number, despite the fact that they are both in contango. Leg 2 is trading at a premium to leg 1, or leg 1 is trading at a discount to leg 2 in both gold and Bitcoin markets. These are contango structures. So why is gold a negative calendar spread and Bitcoin a positive calendar spread? Well, the reason is what we just talked about. Gold is a conventionally priced calendar spread market, and Bitcoin is a unconventional or inversely priced calendar spread market. So gold, the calendar spread is leg 1 minus leg 2 equals the spread. Bitcoin, instead of leg 1 minus leg 2 equals the spread, Bitcoin is leg 2 minus leg 1 equals the spread. So, this is what I'm showing in the book. I flipped the markets, and you can now do the math, and you can see that leg 2 minus leg 1 equals the calendar spread. So let's bring these back into the proper order. But that is how to read the Bitcoin listed calendar spread market. This is a contango market, even though it's a positive number. It's positive because it's leg 2 minus leg 1 equals the calendar spread. Now, the next thing that you will notice in the difference between gold and Bitcoin futures markets and listed calendar spreads is the tick value. So each tick in gold is moving in 10-cent increments, and each tick in Bitcoin futures outright markets are moving in $25 increments. So go back to course 101 and study the contract spec sheets if you need to. All that is covered there. It should be quite clear to anyone who has worked through that course and that book. But this is where we want to focus some attention. So this listed calendar spread is moving in increments of 1. Okay, but the outright markets are moving in increments of 5. So that's why we call this a reduced. That's why we call this a reduced tick calendar spread market, because the listed calendar spread, you can move in increment, you can position yourself in increments of $1 per contract, and in the outright markets it's in increments of $5 per contract. So Bitcoin calendar spreads operate on a reduced tick principle whereas gold calendar spreads operate on a standard tick principle. Each tick in the gold listed calendar spread moves in increments of 10 cents, and that's the same increment as the gold outright markets. So hopefully that clears up what a reduced tick calendar spread is and what an inverse pricing of a calendar spread looks like. Leg 2 minus leg 1 equals the spread, as opposed to leg 1 minus leg 2 equals the spread in a conventionally priced calendar spread market. And that should allow us to now focus on creating arbitrage trading strategies for Bitcoin futures markets that can be utilized in a market making capacity and bring some liquidity as a service provider to these exchanges, either regulated or unregulated, and to the market participants that are looking to transact in these markets. So this is what we're going to learn to do now. The first market we will build a strategy for will be the Bitcoin August 2020, SEP 2020 outright markets, and we're going to populate bids and offers in these outright markets relative to the best bid and best offer in the listed calendar spread. And similar to gold, all the fundamental principles are the same. We're leaning on the bids and offers in the listed calendar spread to synthetically create spreads in the outright markets, and in doing so providing liquidity as we can scratch any synthetic position we put on in the outrights, as there are resting bids that we can sell into and offers that we can buy from, or offers that we can lift and bids that we can hit in the listed calendar spread to scratch our position. So let's go to the AEP and let's build out. We're gonna build out two strategies as we did in part one of this video series for course 201, and we're gonna name these BTC QV or QU, excuse me, QU 2020. This will be leg 1 execution. This is our AEP. So down here we're going to come to select a contract. We're going to make this BTC Q or BTC August and BTC U, BTC SEP. Ratios are good. Multiplier, don't need to worry about it. Not worrying about pay up ticks. We are worrying about active quoting. We want to quote leg 1 as we defined here in the name of our algo, and we want to hedge in leg 2 as we're quoting in leg 1. So now we can go ahead and August QU, yes, save. Now we can go into our AEP and look for this QU spreader. Let's now launch it through an MD Trader window. And oh, excuse me, this is you see this is pricing the other way around. This is a great way to learn why this needs to be, leg 1 needs to be September, and leg 2 needs to be August, to make the math work, to make the math match the listed calendar spread unconventional pricing. So now we can launch our spreader, and there you see how the math is now in our favor. So what we're going to do here is bring these up a bit, and we're going to populate the order books in Bitcoin outright markets on the CME as market makers, with bids and offers resting in the book. So we're going to take a look at our listed calendar spread. We see bids at 121. So we can't bid, as you'll notice, since synthetically we cannot create a spread that is between the nickel prices. Right now a nickel price is 120, 125, 130, and then it would be 115 down here. We cannot create prices in between nickels. We can't create 121, 122, 123, 124 in between 120 and 125 synthetically, because the outright markets move in increments of 5. So when we become market makers in the spread, we're going to be bidding and offering the best nickel prices. So I'm going to be bidding 120 in my book, and I'm going to be offering 125 in the book, and you will see orders populate now. I'm going to bid this spread, which is going to bring bids into my leg 2 market, because we're buying the to buy the spread in this in the inversely priced markets. You're buying leg 2. If you buy the spread, you buy leg 2. If you sell the spread, you sell leg 2, as opposed to gold, where if you buy the spread, you buy leg 1, and you sell the spread, you buy leg 2. Well, this is how you can see that if we're buying the spread, we're buying leg 2. And then if I were to sell the spread at 120, oh, I'm actually working there I'm surprised that didn't execute. It's just because we're in simulation. I'm going to work to buy the spread at 120, and I'm going to work to sell the spread at 125. Now you will see my bids and offers. Hold on here. 125. Yep, I'm working to sell the spread at 125. Now you will see my bids and offers populate here in the September contract. I am working. I'm on the best offer in the Bitcoin September 2020 outright market, and I'm just off the best bid in the Bitcoin September 2020 outright market. So now you're seeing we're bringing liquidity to one of the fastest, one of the most actively growing futures markets in the world, and we're bringing liquidity to this contract, which is pretty cool, and definitely a valuable skill or valuable insight to anyone who's interested in building statistical trading strategies, statistical arbitrage trading strategies, or who's looking to work in establish a career in these digital asset markets. This type of information, this type of knowledge is really just invaluable. So now let's expand our market making capacities to the BTC August 20 outright market. So I'm going to go back into my my algorithmic execution portal, and I'm going to name this BTC QU 2020. Just got filled on a spread. We just sold a spread. BTC QU 2020 leg 2 AEP, and oops, there we go. And let's make leg 1 the BTC. Well, now we need to do it inversely actually. So BTC SEP is leg 1, BTC August is leg 2, and we want to quote in August here. So we're going to quote in leg 2. Active quoting is going to be leg 2. We're going to hedge in leg 1. Which is I know this can get confusing, but just gotta bear with it. The unconventional pricing, and we'll save this. I will now launch this spreader, and now I'll also bid this calendar spread market since we're short one from. We sold a 125 spreader, as you can see. My orders filled here. I'm short 1, long 1. I'm short the spread. I'm short September, long August at a relative value of $125 per contract. Now we're going to open up this algorithmic execution portal and work orders in the August market. So I'll bring a bid at 120, which will work an offer in August because I'm working to buy August, sell September, we'll bring an offer into August as I'm working to sell August, buy September, because I'm buying the spread. What I do to leg 2, I do to the spread. If I want to buy the spread, I'm buying leg 2, so that means I'm working an offer in leg 1. Now I will bring an offer to at 125, which will bring a bid into the August book because I'm working this bid to sell September. What I do to leg 2, I do to the spread. If I want to sell the spread, I'm selling September, buying August. So here's my bid, working to sell at the best bid in September at a relative value of $125 per contract. So now you see, I'll also add an offer here in the calendar spread. Now you can see we are market makers in BTC August 2020 outright markets, BTC September, and I'll bring the offer back into September. BTC September outright markets, and then we are also market makers in the calendar spread. I'm going to bring this up to 130 just to see if maybe that can fill. I'm working at 125, so this would have to fill first, but let's just widen out a bit for the moment. I'm just off the best bid and best offer in both outright markets, and I'm also making markets in the calendar spread. With this established, this QU leg 1 and leg 2 arbitrage strategy that's working as a market making capacity, let's now bring in the October outright market for Bitcoin so we can make markets down the curve. And let's open up October outright. I'm going to minimize the position window. I'm going to drag okay, here's the October outright. So now we have BTC August, SEP, OC, and the August SEP calendar spread. I'm going to cancel setup. Cancel. I'll leave the orders in the listed spread. August SEP OC outright markets, AUG SEP listed calendar spread. Let's bring in the SEP OC listed calendar spread, which is the next listed spread. And SEP OC. Here we go. So now what's interesting here is you can notice, and this is in simulation, but they typically try to mock the books. This is a very wide spread. So this is an as you'll see as when we start to talk about P&L, the types of opportunities, and this is why first mover market makers tend to have the highest reward. This is the spread you can get as a market maker. You can buy let's call it 50, and you can sell 65. So it's $75 per round turn, as that's 1, 2, 3 nickels in the listed calendar spread, which would be equivalent to 3 ticks in the outrights, and we know it's $25 per tick. 25 times 3, $75 per round turn in a listed calendar spread for market makers. So interesting opportunity. And we also do notice that October outright book, although in simulation, fairly good liquidity, which is interesting to see. It also might be suggesting there's many other people testing strategies at this moment. Who knows? All for speculation. So before we can continue here, we have to go build out an algo for SEP OC. So we're going to call this BTC SEP OC UV 2020 leg 1 AEP, and this is always a bit tricky, but this is going to be the October market leg 1, and this is going to be, and that's just the math. You have to label it leg 1, but it's still technically leg 2. BTC September, just for the math to work out properly, and we're going to actively quote in leg 1 here, and we're going to hedge in leg 2 as decided by the TT, but other way to say it, we're actively going to quote in the OC market, and we're going to hedge in the SEP market. So I'll save this there. There it populates. Now I'm going to create another one for our leg 2 execution, BTC SEP OC 2020 leg 2 AEP, and again this leg 1 will be the OC contract October, and this will be the SEP contract as it's priced inversely. We're going to actively quote in September, and we're going to hedge in October. And now I'm going to save this, and I will launch the AEP onto my trading screen. And let's make these a bit smaller so we can really identify what are outright markets, what are listed calendar spreads, and what are AEPs. And let's launch leg 2. Let's bring it down. All right. So now let's refresh what we're staring at here. BTC August 2020 outright markets, BTC SEP 2020 outright markets, BTC OCC 2020 outright markets. First thing we want to identify is this is a contango market. The near month is trading at a discount to the deferred month, or the deferred month is trading at a premium to the near month, however you want to say it. We have a positive slope here. Now it's a positive calendar spread because it's an unconventionally priced calendar spread. It's leg 2 minus leg 1 all the way down the curve. So we see the AUG SEP calendar spread is positive even though it's contango because it's SEP minus AUG, and we see the SEP AUG positive as well even though it's contango because it's AUG minus SEP. So let's now become market makers for one of the most exciting financial products, financial markets on the planet. In August of 2020, volumes exploding, open interest exploding. Everywhere we look in Bitcoin markets, there's an interesting story going on. So let's become players in this market. I'm just assigning quantities here to my execution portals, and I'll assign a quantity in the calendar spread. Okay, let's go ahead and turn this stuff on. So we're going to turn on the first spread we covered, and we're going to check our listed spread. We're going to see its bid still at 120. And now to really get familiar real quick, why is it bid 120? Well, because these are nickel prices. So it's if it's offered at 125 and it's blank at 120, blank at 123, and there's a bid at 122, even though that's my bid, there's a 6 lot bid at 121 that just went away. I'm going to move my bid down. Now I'm bidding 117s. So now the bid moves to 115 because the best nickel price, 125 is a nickel, 120 is a nickel, 115 is a nickel. The best nickel price is 115 here. There's nothing at 120. It's blank. 125 is offered, so best bid is 115, offered at 125, because those are the only prices I can synthetically create in the outright markets, and the bids are coming out of the book in the simulator. So let's go ahead and put some bids in at 115 in my first AEP. Here I'm bidding the spread. I'm buying September. Remember what I do to leg 2, I do to the spread. So I'm buying September here in the AUG SEP spread. I'm buying the spread, buying September. Let's offer the spread. That means I'm going to be selling September. I'm offering the spread. I'm offering leg 2 of the spread. I'm selling the spread. Hope that's clear. And now quickly here we see a 1 lot offer come down to 124. I can still work synthetically at 125 because between 120 and 125 it's blank. So the only offer that could fill is 125. You could fill at 120, but why would you want to sell at a worse price than you could get? So we're now working bids and offers in the SEP outright, the U outright. Now we're going to bid the spread using our second AEP, and that's going to be offering August, looking to buy SEP. Excuse me, we're going to bid the spread, bid the calendar spread at 115, which is working an offer in August, working to buy SEP. What I do to leg 2, I do to the spread. I'm buying SEP, working to buy the spread. And this is actually backing up even further, so now I'm going to move my bids down to 110. As you see, there's no more bid at 115, so the next nickel at play is 110. So now this market's really widened out, kind of, not as wide as the SEP AUG, but you can see how the nickel prices are at play here. So now I'm bidding 110 and I'm offering 125. 125. So I'm going to come into this AEP and offer the spread, which is going to bid August and look to sell SEP. So we can see what that does. Now let's go to the SEP OC spread and let's take a look at that. So this is a very wide spread. It's actually okay, we're getting fills there. Let's see if we get filled on this order here. Or this is working to buy 110s. I could pay up and buy 115s here, and I might do that. Let's see my order. Yeah, I just bought 115s instead of 110s. I probably could have kept it resting and got filled, but I paid up because I'd already sold 125s. So I got flat that position, which is good. And I'm gonna rebid this actually. You know, if it's gonna trade lower, let's bid 105s. See if this market's coming lower. We're technically flat, so let's bid 105s and offer 125s. And I can now offer 120s. I'm gonna drag this down to 120. 120. So now I'm bidding 105, offering 120. You see I'm adjusting my market making strategy as the market is moving and the market is changing. I have to always be aware of what's happening in the market, what's going on. I might even want to come in and bid 110s now because there's a 4-lot bid in the spread. So I'm going to come back and bid 110s. You see this 4-lot bid at 111. I'm going to bid 110s. You know, and theoretically, if you buy 110, you could sell 111 for plus $5 P&L. That's pure arbitrage. You don't even got to turn your spread synthetically. You can just literally hit the bid in the listed calendar spread. You see someone just did that. Someone probably in the simulator bought 110 and just sold that 111. I'll still work to bid 110 because I can scratch. But let's now move into the next to the next outright down the curve, or the next calendar spread down the curve, the SEP OC. I'm going to look at here's my August, here's my SEP, here's my OC outrights, here's the OC. I want to bring some orders in there. So what I'm going to do is I'm going to look at the calendar spread. It's currently being bid at 45s. Remember, you can't bid 49 in the spread. Why would I bid 50 if there's no bids there? I'll just bid 45. Can't bid 48, can't bid 47, can't bid 45. I can bid the nickel. So I'll bid 45 here, and that should bring a bid into my OC outright, which it does. Now I'm working October bids, and I'm going to offer the spread at 60 because there is an offer at a nickel price, so I will match that offer. And I will say I sell 60s because I can scratch. Technically, there's a 1-lot. So now you see I'm working bids and offers in BTC August 2020, SEP 2020, October 2020 futures markets. I'm working bids and offers in the AUG SEP listed calendar spread. And I'm also going to join and make some markets in the SEP OC calendar spread. I'm working to buy here and also working to sell. So look, we have working orders in BTC AUG outright, the SEP outright, the OC outright, the AUG SEP calendar spread, and the BTC SEP 2020 October 2020 listed calendar spread. So this is how you can become a market maker in futures markets for one of the most exciting and fastest growing financial markets in the world. Thank you very much.